In this video, we're going to take a look at the March 2025 newsletter. To start off with, if we take a look at the technical stats for the S&P 500, we can see the S&P 500 had been moving in a strong upward trend for quite some time, but that's recently broken in 2025 and it's heading lower. If we take a look at the market breadth of stocks and measuring it with the stocks trading above the 200-day moving average, that's been declining for quite some time. And if we look at the RSI, the Relative Strength Index here, it's also been heading lower for quite some time. At the same time, the S&P 500 has been moving higher. That divergence often is resolved with the stock market heading lower, and that's exactly what we've seen. And if you take a look here, we've seen the RSI actually move down into oversold territory. So we could see the stock market start to head higher here on a bounce, particularly since we're heading into a strong seasonal period for the market from mid-March into April and into early May as well. I start this newsletter off with the German flag and the EU flag, and that's because of what took place last week. What we saw was a huge government announcement as far as stimulus money coming out of Germany and the EU. This guy here, Merz, was only elected in Germany in late February, so a matter of a couple of weeks ago, and he ran on the promise that he was not going to increase government debt, and yet he did. And he came out with a bazooka of 500 billion euros to stimulate the economy and also to build up the military as well. It was interesting to watch what happened in the markets last week as a result of the announcement for the German government increased spend. If we take a look at the 10-year government Bund, we saw that the daily yield spiked up huge, the highest spike we've seen in years. And this was really the result of investors saying, well, the government came into power announcing they were going to have austerity. They've broken that promise and they're announcing a huge government spend. They could do this again, and this is inflationary. So a little bit of a concern there. We also saw the EU announce a spending package of $840 billion last week for economic stimulus and military spend as well. And what they said was, look, we know some countries are in trouble with their deficits relative to the EU ratios. And we're going to say you can actually not include this spending program as part of that. Go ahead and spend it. Won't really count as far as that goes, which is insane because it's still debts for these countries here and they still have to manage that. Anyhow, it's kind of interesting. Now, the result of this announcement of spending, the typical result, the Keynesian result from the news was that the defense, according to Reuters, defense surge could help jumpstart the European flat economy. Yes, in the short term, dumping money into the economy and spending money will give the economy an artificial boost. But you're borrowing from your taxpayers and you're robbing future growth and productivity here. And you could be causing longer term problems here. So, but nevertheless, in the short term, we could see the economic activity pick up. In fact, we've seen the European stock markets performing quite well this year. It's partly the result of the U.S. stock market, what's happening in the U.S. stock market. So what's happening in the U.S. stock market, if we take a look at the technology sector using XLK here, we can see that the technology sector has broken out of a consolidation rising wedge and broken lower here. And it's dropped below its 200-day moving average. And relative to the S&P 500, it's been this consolidation box for a year and a half. It's now broken below that. Now, the technology sector is an interesting sector because this is one of the sectors of the market that Europeans and other foreigners can't really get so much in their country. Yeah, there are the occasional technology stock, but there's no Apple or Microsoft. So if we find that the technology sector starts to go down, sometimes what you'll see is that the foreign investors will start to pull their money out, which will cause the technology sector to move even lower. And if they start putting it into their own market, we'll see it move higher. And that's exactly what we've seen this year so far. We've seen the European stock market outperforming the S&P 500. We've seen China actually doing well, emerging markets. So we're seeing some of that money being pulled out of the US stock market and going into other markets. This graph shows exactly what's been happening recently. We can take a look here. This white line is the end of 2024. And this white line here, moving down, is the S&P 500. And we can see that we're actually lower year to date for the S&P 500. But look at what's happened with China. We've seen China actually ramp up quite strongly in 2025. And this yellow line here is emerging markets. Emerging markets has actually been performing quite well relative to the S&P 500, as has, in this case, Europe as well. So we've seen a number of the other markets outside the US actually going higher. We've seen the DAX hit all-time highs not too long ago. Now the economy is in a real slump, but we're seeing money pouring into the stock market on some expectations around defense stocks and others. Now, just to show you a little bit about how this could play out, let's go back to the late 1990s and 2000s here. Now, the tech wreck and what took place then, it's different compared to today. Today, the tech companies have earnings, et cetera, but there are some similarities here. This graph actually shows you the US dollar back into the mid-1990s. Look what happened in the tech wreck in the late 1990s. The US dollar rose dramatically. And at the time, it really didn't make sense because what was taking place was the U.S. had a huge trade deficit, and what should have been taking place is U.S. dollar should have been going down, and it was increasing over time as well. We saw this rapid rise in U.S. stocks, and that's because foreigners wanted to get in on the action, the tech stocks. And so to buy tech stocks, they had to buy the U.S. dollar to buy the tech stocks, and that pushed the U.S. dollar up. Well, look what happened at the top of the market here. As the stock market did correct, we saw the U.S. dollar and international investors pulled their money out of the tech stocks. We saw the US dollar over the next few years head lower relative to world currencies. And then what we've seen more recently is we've seen in this, really since 2010 or 2009, we've seen the US dollar once again perform extremely well. And as the technology sector has dominated once again, and we've seen that money pour in from other countries. We are starting to see a little bit of this downward tick here. It isn't anything like what we've seen in the past. We have to watch out for this a similar phenomenon taking place if we continue to see the tech sector not being loved and international investors pulling out of the tech sector. We could actually see the US dollar head down lower over time. It's interesting to take a look at what's happened with the US dollar relative to the first time Trump was elected in 2016. The patterns are eerily similar. If we take a look here, we can see when Trump was elected back in 2016, this yellow line here, what we saw was the US dollar rising relative to world currencies before the election and into really late in the year. And then in this case here, at the end of the year, we saw the US dollar actually start to head lower dramatically over the next number of months. Well, what we saw in 2024 was we saw the US dollar head higher into the election, head higher after the election, and at the beginning of this year, we've seen the US dollar actually head lower. I'm not going to say that it's going to happen again just because of this, but this is an interesting analog. I know I spent quite a bit of time in the US dollar here, but I do think it's important because there's some real shifts taking place in the marketplace, and there's going to be a lot of talk about the US dollar, whether it's strong and how it's affecting the different parts of the market. If we take a look at this graph here, in this case, we're taking a look at the correlation of the US dollar relative to the S&P 500. Typically in the past, what we've seen is when the S&P 500 goes down, the US dollar is a safe haven, and investors move into the US dollar. And that hasn't been happening, because here we are right here. And this is, in this case here, where this is the S&P 500 index, so if it's moving higher, and this is the US dollar moving higher this way. So when the S&P 500 has moved lower, typically what you'd see in that case is you'd see the US dollar move higher. But right now we're down here at this level here. This is saying to us that investors, as the S&P 500 has been moving lower, have been moving into other parts of the market, or commodities, or whatever it is, but it's not the S&P 500. Recently, the Treasury Secretary, Scott Bessent, made a comment. He said that the market and the economy have become hooked, become addicted to excessive government spending, and I agree. And there's going to be a detox period. That's probably going to be the new phrase of March or April or of the year, the detox period. Because what he's trying to do is he's trying to say, well, the government's been spending way too much money on a whole bunch of programs that never should have been used and hired way too many employees, and all of which I agree. And we're going to cut that back, and then we're going to, and I'm not going to get into the politics of what is being spent on, etc. But we're going to cut that back, and we're going to transfer that stimulus into the private sector. And that's the right thing to do over time. But this could be a bumpy period for the economy and for the markets. We could see this U.S. stock market actually get hit for quite a while. It's possible that Trump's trying to front load all of the pain as he tries to clean up a lot of this, the mess the economy is in. So watch out for the word detox period coming up quite a bit in the near future. Now, this graph shows the uncertainty economic index, and with tariffs going on, off, hourly sometimes, and a whole bunch of confusion, what we've seen is we've seen economic uncertainty rise rapidly. This is not a good thing. I'm not a fan of the tariffs at all. They don't make any sense for anybody. There's certain tariffs, I've done videos on this in the past, that do make sense, such as protecting your national security would be one, or if another country is dumping a product into your country at below production costs. Those are the only two cases that they make sense. Canada actually has a whole bunch of tariffs it should not have, but the US, with what they're doing right now, and the tariffs is wrong as well. And Europe also is wrong with the tariffs that they have. But right now, it's the US that's going around the world and really trying to have all these blanket tariffs. I don't think this is a good approach. But this has created this economic uncertainty here, if you take a look at this graph. And the problem with that is businesses don't like economic uncertainty. And it makes it very difficult to invest for the future. In the intro part of the newsletter, I also talk about Japan being a possible black swan. If you take a look at what's happened with the yen, we've seen inflation start to go higher in Japan, and that's put them into a box. Remember, they're zero for a long time. So we found the government borrowing huge amounts of money. They now have a 248% debt to GDP ratio. I don't want to get into why they'd be able to get away with that. It's a long story and it's outside of what I'm trying to do here, but it's problematic for the future. And the government actually owns a huge amount of the ETFs on the market, and also as well, they actually own huge amounts of government bonds. Well, the problem is right now is we're seeing inflation start to tick up, and to combat that, they've been increasing interest rates, and that's actually increased the value of the yen. So the yield on the 10-year yield here, you can see for the yen has been going up. And in this case here, here's the currency. The currency for the yen has also been increasing. So why is that a problem? Why am I mentioning that? Because Japan's connected, just like the US is, to the rest of the world. We're in this multi-connected world, and there's a yen carry trade. And the yen carry trade is when investors, usually institutions or large banks, borrow money in Japanese yen. Typically, they've done in the past almost 0%, and then they flip that money into US dollars, and then they take those US dollars and buy US bonds or stocks, and sometimes use leverage as well. So really getting free money to operate on. So that, in fact, is leverage. And that's the yen carry trade. But it's great while it works, but it's problematic if things start to go wrong. And one of the factors, if we do see, let's say, for instance, if the investment's been in US stocks and they start to go down, that actually, if there's leverage involved in there, that could have forced selling. But if the yen increases in price and the yield on the Japanese bonds go up, it's now going to be more costly for that yen carry trade. And that's going to squeeze the institutions that have used this trade, and they're going to have to unwind the positions in the US to come back and pay for their debts, their borrowing in Japan. And that's the unwinding of the yen carry trade. We saw last year in 2024, we saw a brief period where this did occur as Japan raised its rates a little bit, and it caused a huge problem in the US stock market. Now it went away. Everybody said, oh, that's cleared the yen carry trade out. This yen carry trade has been going on for not just a year or two. This has been going on for many, many years. It's going to take a lot longer for this yen carry trade to be cleared out. So it is a problem. I think Japan could be a black swan in the future. I've been saying this for quite a while. It is a train wreck. They're going to have huge problems at some point in the economy. They can't help that. It's just a matter of when. This is a train wreck happening in slow motion. We're watching it happen. Maybe it's 5 years, maybe it's 10 years, maybe it's 3. I don't know when it is. But if we see rates rise higher, that means the government now has to spend more money to maintain their huge debt to GDP. And this could have an effect on international markets. Just something to watch out for. I talked a little bit about the seasonal trends, and I have a happy face here. Okay. And that's because we're coming into a period in the marketplace. Yeah, we are in that strong seasonal period from late October to early May, but there's different weak spots that can occur. But we're coming to a strong period for the market from mid-March to really to the end of April, in particular to the middle of April as well, but to the end of April and even into early May when the 6-month strong seasonal period ends. So I've got a little happy face here. I'll show you the trends. So this is March. From 1950 to 2024 here, you can see that halfway through the month, right here, is when you see the biggest bump goes on a seasonal basis on average for every year. And if we take a look at more recent years here, so the last 20 years here, we find that in the last 20 years, March has actually been negative in the first half of the month and has produced a strong return in the second half of the month. If we look at April from 1950 to 2024, we can see that April does extremely well. It's actually a very strong month, but in particular, it's the first half of the month that tends to be strong. Now, let's take a look at this case from 2005, so the last 20 years here. You can see here that April has been strong basically right throughout the month, which is good news. So we've got the second half of March and April that looks good on a seasonal basis here. So we could see the market bounce from an oversold position right here. So we do have seasonal tailwinds to help us out in the near future. Oh, and I included a happy face here. Sorry, a sad face, because we are getting to the end of the 6-month favorable period for the stock market here, which is on May 5th, early May here. So we are getting close to that time period. Now the stock market can go past that and be strong and can finish up a little bit early as well. But we are coming to that time period. I'll be addressing that in the future. If we look at some of the sectors for seasonality, we're going to start with gold. Gold had a fantastic year in 2024, outperformed the S&P 500, has put in a double bottom and broken above that level here. Now, I did do a video talking about how we can see gold, and gold miners actually had this mini weakness, period of weakness from mid-March to mid-April. That hasn't played out. We've seen gold actually perform well, and gold miners perform well. It really shows the strength of this sector. Investors really are looking for other sectors of the market. They're moving away from the growth sectors of the market at this time, and they're looking for other sectors. And there's other reasons as well. We're seeing a lot of international interest in gold, which has been pushing gold price up, which has helped the gold miners as well. Gold and gold miners both have a strong seasonal period, a mini seasonal period from mid-March to mid-April. Now, I do want to say, if we take a look, so here's gold here. And if we take a look here, here's 2023. We can see that gold really peaked in April or May, and then actually went down from there into October. And if we take a look at 2024, it peaked in April and then really went sideways for the next few months before we're entering this next strong seasonal period. So we can see gold and gold miners actually do quite well here for the next month. But after that, it tends to be one of the weaker seasonal periods for gold. If we look at the energy sector using XLE, the ETF, we have seen this consolidation period taking place here, even relative to the S&P 500. And we could see it rise up here relative to that line here. The top line is consolidation box. Energy is an interesting situation. We're in that strong seasonal period. There's a lot that could drive it higher, and there's a lot that could move it lower. If we do see a peace develop for Russia and Ukraine, then that could take out some of the premium in the energy market. But we do see the situation in the Middle East heating up again a little bit. So that's a very difficult one to call. We are seeing some economic slowdowns in different places around the world, but China is picking up here. Europe is adding more stimulus, so we could see some interest in, a lot of investors might try and play that through the oil sector. So we could actually see the energy sector do quite well in its strong seasonal period. April tends to be the strongest seasonal period, strongest month of the year for the energy sector, so that's coming up. I also have here small cap sectors, IWM, and they have a strong seasonal period from December 19th to March 7th. This sector has not performed well in this seasonal period here. The investors have just been focusing on large cap stocks. They've been moving into defensive stocks, consumer staples, utilities, healthcare, and the small cap stocks have not done it here. We've seen actually relative to the S&P 500, we've actually seen a recent breakdown from that. Now, I put it on here because we're at the end of the strong seasonal period for the small cap sector. And typically from March, over the next little while, the small cap sector does not do well. So it's likely we could see that sector head even lower. I found this graph interesting because this orange line is the small cap sector, and the blue line here is credit spreads, option adjusted credit spreads. You can see here that there tends to be an inverse relationship between credit spreads and the small cap sector. When the small cap sector performs poorly, credit spreads usually rise because there's risk in the marketplace. That hasn't happened. Credit spreads are like at historic lows, and small cap stocks have actually been pulling back here a little bit here. So the credit market saying we don't see a problem, the stock market saying we do. It's usually the other way around. We'll have to see which way it plays out. If we look at the industrial sector here, this is actually a bearish pattern, lower highs. It's a descending triangle, but we've seen a lot of this in the different sectors of the market. But relative to the S&P 500, the sector's been outperforming. That's because the money coming out of the technology and growth sectors is looking for a home, and the cyclical sectors are one of the places that it's going to. The industrial sector is attractive because with onshoring, that would help the industrial sector a lot as well. So it's benefited a bit, hasn't performed particularly well on an absolute basis, but it has been outperforming the S&P 500. And not walking through all the details here, but we've seen the same phenomenon with the material sector here. It is actually at support here. So it's going to be interesting to see what happens. This is an interesting sector. This is the metals and mining sector. If we take a look relative to the S&P 500, it's in a consolidation box. It's been there for a while. A lot of volatility. Some days are huge for the sector, and some days are negative on the downside, huge. So we've seen this volatility taking place, but it's really been flat to the market. We haven't seen that really strong breakout, despite some commodities performing well. We'll have to see if that gets transferred over to the sector. Right now, we're coming to a period where the sector may actually do well in April, but watch out because May tends to be a weaker time for the metals and mining sector. This is the consumer discretionary sector, and look at this. We saw that huge run-up for the consumer discretionary sector in November and December, and we saw that break that upward trend relative to the S&P 500 and also as well on an absolute basis. But since then, the sector has performed poorly. This is investors basically leaving the growth sectors of the market, and so we've seen that underperformance taking place. The sector is in a strong seasonal period, but this one is not working out, and the sector is underperforming. This graph shows the Canadian banks. And if we take a look here, we've seen this consolidation period on an absolute basis for Canadian banks and relative to the S&P TSX Composite Index as well. Now the Canadian banks, we saw that big huge run-up that took place last August into September based upon their strong earnings at the time. Canadian banks can perform well on initial stages of the downturn because they have a high dividend yield. Investors go, well, I'm going to hide in dividend yielding stocks. And so Canadian banks, oligopoly, et cetera, this is where we're going to hide. If we see a sustained market downturn over time and recession indicators really start picking up and there starts to become more of a concern, that's when this gets problematic for the Canadian banks. And we can see them underperform. So we'll have to watch out to see if this Canadian banks actually start to break down relative to the TSX Composite Index. Here's the emerging markets. We can take a look here. We can see that it's got a pattern of higher lows, which is a good bullish pattern here. It's actually been performing well. It's been outperforming the S&P 500, which is a positive. We've seen the emerging markets really benefit from a weakening US dollar, so we could actually see this sector perform quite well. Further, if we see the US dollar moving lower. This graph shows the Canadian dollar relative to the US dollar. The Canadian dollar has followed its seasonal pattern somewhat over time. Here we can see last fall it went down relative to the US dollar. And that's a typical seasonal tendency at the time. Recently we have seen a consolidation taking place, huge gyrations taking place as the tariffs have come on, off, on, extended, paused. It's been very, very difficult, and markets are almost just giving up and trying to accommodate what's going to take place here. Now, the Canadian dollar has actually done relatively well in this situation now, considering that the price of oil has moved down. And that is usually one of the factors that can hold the Canadian dollar higher. Now, I do want to say the Canadian dollar tends to perform well from mid-March until the end of April. Especially if we see the price of oil head higher, that would really give the Canadian dollar a supportive boost. Very difficult to tell what's going to happen with the tariffs here, but if we look at this consolidation box, if we do see a breakout from the consolidation box here, we could see it move higher on a technical basis coming up. Here's a graph on utilities. In the States, XLU, you can see here the utility sector has been outperforming the S&P 500. The reason I put this on is we can see utilities actually perform well from now until late May, actually. If the market's going really well in a risk-on environment, typically the utility sector doesn't do that well at this time, but in this environment it can, and we're seeing the utility sector actually performing quite well at this time. In my rants, I talk about the tariffs. Tariff talk again. I compare the tariff, what's going on to ping pong. It's hourly what's taking place. And if you want to read about what my interpretation of it, I've got some of the tariff talk. And also I did this video back in February. It's still quite relevant. There's been a whole bunch of changes, but it's still quite relevant on what's happening in the tariff talks or trade war that's taking place. In my second rant, I say, do not count government spending in GDP. The formula in economics is GDP equals consumption plus investment, plus government spending, plus exports minus imports. And I'm saying government spending probably shouldn't be included in here because it incentivizes governments to go off and spend huge amounts of money, which artificially in the short term stimulate the economy. In the long term, they actually hurt economic growth. And there's been substantial research to say that, yes, we used to believe there's a positive multiplier from government spending, but it's actually negative very quickly. And the overall impact is negative on the markets and the economy. And as a result, I conclude in here that really we should have a separate calculation for GDP, or at least itemize out government spending and not include it. Mainly so governments aren't incented to just spend artificially to increase their GDP. In my third rant, I make fun of the European government, the EU, and I say, EU getting ready to surveil and modify consumer behavior. Why? Last week they came out with an announcement saying that they were going to be launching a digital euro in October of 2025, this year. They call it a digital euro. Now, this is being totally disingenuous. It's making people believe that they're just swapping their cash payments for a digital version to pay. This is not what this is about at all. Yes, that is partly true. You will use a digital system. Now, they're going to run a parallel system before you get too excited. So you will still be able to use cash and credit at the same time as using the digital euro. Now, they're probably going to run these parallel systems for a couple of years and one day come along and say, you know what, we're taking cash right away. You have no choice but to do the digital euro, central bank digital currency. The problem with the central bank digital currency, and I ranted about this before, and I've encouraged people to write into governments and to really try and stop this process from taking place, is just look at what China is doing. And it will tell you, this is so dystopian. China, in some of its provinces, is testing this out, and they're creating a social credit score using a central bank, a digital currency, so a digital yuan. And so if consumers don't have the right credit score, they've crossed the road incorrectly, they get demerit points. Their points are deducted off their credit score, and they can't travel. They can't even get out of their own neighborhoods. I'm not making this up. This is just the way that they are trying it out. Down the road, it's easy to see that the governments will come along and say, hey, you've traveled too much last year. You can't travel this year. You can only travel once every 2 years. They will try to modify behavior. They will never tell you that to begin with. But the BIS, which is the Bank of Central Banks, the Bank of International Settlements, has actually said that. Yes, we want to create this system so we can track behavior. So this is not a good thing. And if the wrong government gets in power in a totalitarian way, you can see consumers losing all of their freedoms. So anyhow, this is my rant again on this because we did see that being announced this week. I'm not a fan of this. It's easy to see why it's more convenient. People go, yeah, I want digital. That makes a lot of sense. But there's some huge, huge dangers about this. It really is a surveillance currency, and that's what they should call it. Thank you very much for joining me today.